2022 will likely be remembered as the year of peak regulation for China's equity markets. There was tightening of regulations in various sectors across China, such as internet, education, healthcare, and property that had dragged the market performance. At Eastspring, we benefit from having a geographic presence across Asia, with Asia being our key focus region. That means that we can have an on-the-ground feel and do site visits if necessary. That brings another dimension to our independent research, complementing the vast secondary research that we have access to. Broadly speaking, when market conditions are healthy, we would want a higher portfolio beta to capture better returns for our investors. And the reverse is true when conditions are tough, like now. We also look at absolute levels of market volatility to assess the level of risk the fund would like to take on. In recent times, we have been paring down our exposure to the IT sector, for example, where the beta of stocks in the sector are generally higher. This would not be the first time investors are skeptical on the Chinese growth story. We had similar episodes in 2015 during the growth slowdown and currency devaluation, in 2018 during the US-China trade war, and right now. Each time, policymakers have been able to navigate past these situations. We continue to see many Chinese companies rising to become industry leaders in their fields. The most closely watched statistic in China now would probably be the COVID-induced movement restrictions and how that will be managed. Prolonged restrictions are likely to last until after the Party Congress in the fourth quarter. This favors a more defensive investment strategy, favoring sectors such as utilities and telcos. On the other hand, lockdowns have created a growth gap versus the government's target of 5.5% this year. This will likely bring forward infrastructure-related stimulus, benefiting sectors such as construction and building materials. The policy tone that had caused a drag to markets last year has already reversed, turning more supportive in our view. While that is a positive, we think investors are still waiting for key catalysts such as the relaxation of movement restrictions across China and the end of the Russia-Ukraine war that has caused a spike in risk premiums investors demand when investing in China. Our portfolio strategy currently utilizes a barbell approach of having both defensive and growth sectors. On the positive end, we favor sectors such as industrials and building materials that tend to benefit when government spending picks up. On the opposite end, we are positioned in utilities or companies with high free cash flow or dividend yields that could provide a stable return during tough times like these. Currently, the growth outlook amidst the persistent lockdowns have affected supply chains and the outlook for consumer spending. Foreign investor interest is another uncertainty. Valuations has certainly come off. The MSCI China Index now trades at 10.5 times FY22 earnings versus its historical average of 15 times which it has traded in the past 5 years. Which means to say that if growth recovers from the current slowdown, there could be some opportunities to be taken advantage of, with many companies in China offering compounded earnings growth of above 20% in the next few years. Recently, we have noticed increased disclosure from Chinese-listed companies in terms of carbon emission levels and reduction plans, as well as environmental protection initiatives. This is in line with the central government's goal to become carbon neutral by 2060. Local bourses such as the Shanghai and Shenzhen stock exchanges have also encouraged listed companies to adopt standards and practices in line with global best practices. Examples of this include promoting employee diversity and independent board representation. Diving into the Chinese investment universe, we see ample opportunities in China given that it is the world's leading producer in renewables and it has a well-established supply chain.